Well, good evening and welcome to another InsTech London event. It's great to have you. I guess we've been, now about 9 months into not doing face-to-face events, and the fact you're still hanging in there and joining us is tremendous. But no surprise, we've got a fantastic event today. One thing I guess is in common with anybody who's doing business anywhere is, where does the money come from? So a chance to hear today from 4 fantastic founders, well, 5 really, including Andre, of course, who've built businesses, raised funds, and have really generously offered to share some of their top tips with you. And this event is such an exciting one that both Robin and I are joining it. So you're going to see myself first of all, and then at half time we're going to juggle the chairs, and Robin's going to come along with a couple more people to talk to you. But first of all, a couple of logistical questions. So those of you who haven't joined us before, we do of course welcome questions. On the right-hand side, you'll see there's a little question mark on your screen. If you write your question in there, we'll either take it as we go, or we're going to get everyone back together at the end, assuming we have time, and take the questions then. And if we really don't get to your questions, then we'll have them recorded and get back to you on those. And now we are going to be recording this as well, so if any of you are watching it and want to send it on to your colleagues afterwards, you can do that. And then finally, in these days of heavily overloaded Wi-Fi's, depending where you are in the world, sometimes we get a bit fuzzy, but don't worry, we will be back. And if any of us drop off, we will, of course, the show will go on. So please don't leave us if things get a bit shaky as we go. We've been there and survived. So first of all, I'm going to introduce Andre. Andre is Chief Operating Officer of Genasys, and also heading up the foray of Genasys into, I guess, Europe, we might call it now, and UK. Andre, and has very generously helped us by supporting this event as a sponsor. Genasys, sometimes, despite Andre's youthful looks, is known as one of the oldest insurtechs in time. But Andre, thank you very much, and delighted you could join us today.
It's an absolute pleasure. Thanks for having me.
Now, you and your colleagues have been building policy administration systems and sort of associated technology for quite a while, and anybody who wants to know more about what you're doing, I'd thoroughly recommend our podcast, chance to hear you and I talking, podcast number 106. But for you, what was the reason that you felt is important to support this event?
So over the last couple of months into a year of us operating in the UK, we've helped a number of startups launch their businesses in a digital fashion. And while they are very successful at what they do, a lot of them are relatively small, and they look to us for some advice about how do they fund their operations and their expansions, and how do we raise capital. Now, that's kind of a funny question, because Genasys has never raised capital. We've always been self-funded, and we've funded our own product, and we funded our own international expansion into the UK and into Europe and into the US now. So we thought, well, we can't really give these people much advice, and we really want to help our partners. So why don't we rather bring together a bunch of people who have done this, and we listen to their story, and our partners can learn from them.
Fantastic. And of course, people you've been working with have actually also had some great experience with that, and actually been successful both in terms of fundraising, of course, working with your technology. But you've seen a lot of people. You've been around different organizations for a while. I mean, if you had to characterize what makes organizations successful as they go out and raise funds, there's a lot of things to answer in there. But for you, from your experience and helping people who are out there raising funds, are there a couple of sort of key things that you see sort of consistently characterize successful founders?
Yeah, absolutely. Look, I think the short answer there is, and it's going to be very cliche, but it's, you need to find a really good bunch of people, and people that you can invest in. So I've personally invested in 4 insurtechs myself, and not ones that I overly scrutinize their LTV CAC ratios or their rule of 40. You know when a team is backable, whether they can run businesses. I mean, you look at someone that's themed like Sam, and you would kind of back her without even knowing what she wants to do, because you know it'll probably be successful. So I think having a good, strong team is really important.
Great. And you know how much we love unpicking acronyms here. So just for those that don't know what LTV means, you have to explain the full definition of what it is, but just what the letters stand for.
Yeah, no, it's when you talk to the VCs and the PEs, they get quite pedantic about what is your customer acquisition cost and the lifetime value of those customers, and then your rule of 40 was also quite a big one that the VCs like these days.
Okay, and the rule of 40 is?
It's your percentage. It's how you can turn your business around from growth to profitability, in short.
Okay, well, it sounds like there's another discussion around that as well. But
I'm sure we'll have a lot more input about that.
Okay, Great. And then when we were talking before, you had some very clear opinions as to once people have raised money, what they should, or maybe more importantly, what they should not be spending their money on. So again, if you look at people who've been successful, what choices they're making with their spending.
Yeah, the ones that have done well that we've partnered with, or that we've seen grow, are ones that have really been efficient with their capital. I mean, look, being a self-funded company, you learn to be quite capital efficient, but it's also the ones that can actually unpick the buy versus build question. I think that whilst there has been substantial growth in the D2C direct-to-consumer insurtech space, there's been a massive growth in the B2B space and technology offerings. So you don't need to spend a lot of money building your own technology anymore. There's a plethora of suppliers out there, very cost-effective, quick-to-market suppliers that startups can lean on, and rather look at potentially buying rather than building.
And of course, if they want to go and talk to people about building, the name is on the, not quite on the can, but on the sweatshirt, the hoodie.
Yeah, they're welcome to talk to us.
Great. And then finally, just from Genasys, anything we should be looking out for in 2021?
Well, as always, we'll be reinvesting in our product, and we'll be looking at creating bigger and better ecosystems. We've got a couple of announcements that are going to come out next week. But hey, this capital raising exercise seems quite fun, so maybe we'll do that one day.
Great. Okay. Well, we'll come back to you later on, but many thanks for supporting this. So, Goncalo, I want to switch over to you now, and delighted to welcome you as today the founder of Rnwl, but you've already been out there with one successful business with Syndicate Room, which so we get like a double whammy with you. We get someone who's built a business with, I think, 250 companies you said had been through Syndicate Room, which was a crowdfunding site. And of course, you're now building your own business, and no surprise, but the stats are fantastic. You can tell us how quickly you raised it. But you're on Seeders, and you hit more than 3 times your target fund raise in Seeders. So congratulations. There's a huge amount of things we're going to unpick from you. But first of all, perhaps you should just tell us a bit about what you're going to be doing with Rnwl.
Yeah, thank you very much. I think you were a bit too kind with your words. So Rnwl is effectively the problem that we're addressing is the auto renewal, but also the just simply managing your insurance policies as a consumer. So the whole concept here is it's a pain that I felt personally as I had just stood down from the role of CEO and founder, of course, of Syndicate Room, and I was going to take a few months off and go traveling, and I got this. The letter that we've all received in the past of the auto renewal letter. Hey, Goncalo, don't worry about it. Your car insurance is absolutely fine. You don't even have to look at it. And in small letters, oh, hang on, that's a lot more than I paid last year. And then I started digging, and basically a week into several months worth of traveling, I just came back to England to start Rnwl. And what Rnwl does is that it addresses all of those renewals, as the name says, for you as a consumer. So not just car insurance, but all sort of insurances. And it's an over-the-top insurance platform where you can manage all your policies, you can buy, it manages the renewals for you so that you don't waste time or money.
And when you say over-the-top platform, can you just explain what that means?
Yeah, so that's a fancy way of saying that it plugs into loads of legacy systems so that we can run. So basically, from the consumer's perspective, all they see is one dashboard with their policies, And then in the back, behind closed doors, we all sort of working frankly and just having all these APIs and connectors to all sort of legacy systems, and some of them actually very modern systems as well.
Great. So for anybody in the world that's wondering why insurance is a choice, you've seen 250 companies, therefore I assume 250 different business models, and you've decided to come into the world of insurance. That's a fantastic endorsement. Either it means it's a great opportunity, or it means, and I'm sure Sam has a view on this, it means the thing's so broken that actually you still got a great opportunity to fix it.
Well, I can tell you, I started Syndicate Room when fintech was barely a word that barely existed, really, in 2011, 2012. And what I can see in InsurTech is very much, it's just happening exactly what happened in fintech, which was a huge room for disruption A lot of really exciting companies and entrepreneurs coming with new propositions and that truly disrupt the space. And to be honest, I think InsurTech is barely scratching the surface of what can be done. When I started Syndicate Room, Monzo, Revolut, and Starling were not even an idea yet. And I think InsurTech is at that same, same position in time.
Great. Well, let's just talk a little bit about your own fundraising experience. So you went through crowdfunding, you used Seeders as a platform. I know you also had some angel investors behind you as well to do some of that initial support. But can you just talk through, in your mind, the sort of thought process you went through about where to look for funds and why you've ended up doing it the way you've done it?
Yeah, of course. I think it's important to understand that when I tried to raise money for Syndicate Room, when I wasn't known or anything like that, it took me over 2 years to get the first seed round. So I know how painful it can be for entrepreneurs to get that seed funding. Now with Rnwl, because of my background in Syndicate Room, but also the network of contacts that I developed, it didn't even take me 2 weeks to go from start to finish with the first seed round. So I was just very, very lucky with the background and the network of contacts. And that was just basically I didn't even have a PowerPoint when I sell spreadsheet. It was just on the back of an idea and people that trusted me. And then the second round, when I went to do it, because Rnwl is all about serving the customer and as such a strong value proposition for consumers, it just made complete sense to do via crowdfunding, and that's exactly what I did with Seeders. And I had a great time. It was really good to get potential future customers, word of mouth out there, brand advocates, and to raise 3 times more money than we were actually asking for. So can't really complain there. I was very lucky.
There's a lot in there. So it's worth unpicking for a second. So you went down the Seeders route because you wanted to get a broader customer base. So that was a way of signing people up as investors, but also you'd hope they then come on board as early clients, which is a model I think that Risk used as well. But yeah, that certainly makes a lot of sense. How, in terms of numbers, did you, going into the fundraising, did you have a view as to how many people you thought you'd get signing up through Risk?
Not a clue. So we end up with 624 investors, which is great, because if they tell 3 people each, then suddenly you have a massive reach before we have even launched. Bear in mind, we haven't launched yet. So as a B2C proposition, that is a great starting point. It's also a very, very risky, but we came out okay out of it, which where you're validating our value proposition. Because effectively, we told our potential future customers, hey, this is what we are doing. And we're not even trying to sell them. We're trying to do something harder, which is, do you want to invest in us? And 624 people decided that it was a good idea, which it's very humbling. And
just to keep going with that crowdsourcing piece for a minute. So for people who haven't got that track record like you had, is that still a sort of viable route to go through? And actually haven't got a track record and don't have any revenue coming in because you're still an early stage business. Is that a viable route, or is that really only recommended if you've already got a track record?
No, I think crowdfunding, one of the big benefits is that actually the track record as an individual is far less relevant as it is when compared to business angels or VCs. And that's the beauty of it, is it all comes down to your value proposition. This is, sorry, just to highlight, this applies mainly to B2C businesses. When it's B2B, it's slightly different approach. But certainly when it's B2C, so business to consumer, just to clarify what that means, then it's all about the value proposition. And if you can explain it in a really clear and succinct way to your potential future customer, and they and they think, oh, actually, you know what, this is something I would definitely use. This is a pain point I recognize. This is a solution I would love to see in the market. You know what, yeah, I may invest. And some people invest £10, some 500, some 5,000. So it's a great way to validate your value proposition.
And just going back to it took you 2 years for the first time round. Is there anything, or ask the other way, what would you have done differently for your first company, given that most people, not going to be in the position that you are of already having founded one company and then accelerated fundraising for the second. But if people are starting off from scratch, what's your kind of recommendations about how they reduce that timescale to raise funds?
Well, try to validate your value proposition, potential customers. Just have a holding page, explain people what you do, try to see if people sign up. So we did that. We did that first, and then if it is a B2C proposition, I think crowdfunding is an excellent route, because you get really good questions. So don't get annoyed that some of the questions are so good that you think, wow. Oh, I didn't think about that. Be prepared for tough questions, as they should be, but they are from people that are, by and large, genuinely interested in seeing you becoming successful.
And I think also there are some angel investors now that are going through the crowdfunding platforms as a sort of efficient way of finding the opportunities and actually just funding, as opposed to having it to be more kind of personal networks.
Well, to be honest, I think that is what crowdfunding platforms want you to hear. I'm not entirely sure it's quite as true. There are certainly private investors that want to do EIS investments in a sort of more passive way, and they do it through those platforms. But in terms of business angels that are more hands-on in providing support, my experience is that they usually like to get to know the entrepreneur and have some sort of rapport, and they are putting their money in, but also their time, and they want to do it with someone that they think, oh, you know what, I'm actually going to have really good fun helping this person, this entrepreneur.
Have fun and actually make some money as well, hopefully. And for people that need to find those angel investors, where would you recommend they look?
Yeah, so that's the tricky part. I think when it comes to angel investors, that's where your sort of reputation or track record really comes to play. Because then, using my example, when I started trying to raise money for Syndicate Room, was such a painful, long process that was, it was a very lonely process as well, because you're starting to get this, trying to get this thing off the ground. No one really believes you. You approach business angels, they have no idea who you are, so you're just one of 100 emails that day, and it's really hard to come out. So the best way you have is try to see your local networks and try to get to meet other angel investors through introductions. Every time you meet an angel investor, your mindset cannot be, I need a check from this person by the end of the 30-minute coffee. The mindset has to be, I want this person to want to help me, and I'm going to ask, I'm going to impress this person enough so that this person introduces me to another 3 people, because those other 3 are very likely to be business angels, probably closer to the area that your business operates in, and therefore more helpful to you. And that's exactly what I did for Syndicate Room. It does take time. That's now with that people doing it remotely is actually a lot easier to develop this network quicker. But before, it was it's hard. But you meet 1 or 2, that becomes 3 or 6, and then so on and so on.
Great. So yes, your recommendation is use each network contact to make more contacts. And then what about filtering out the people who are just kicking tires versus those that are genuine investors, whether it's angel or later stage VC round? How do people sort of figure out where the real money is?
Yeah, so those people are just kicking the tires or just bored at home and they just want to hear about new ideas. They are the greatest waste of time you may have as an entrepreneur trying to raise money when, by definition, your company or you as an individual are running out of cash. Sadly, there's no real clear way of filtering those individuals out, or VCs for that matter, those investors out. But if you can, absolutely try. If it's a VC, it's slightly easier, right? Because you can see online the investment thesis, when did they raise money, how much money, you can sort of imagine how much money they have left based on their press releases. And you know what? If they're not the right VC for you, don't take the meeting. Don't waste your time, because they are in the business of owning information, in the sense, if they want to invest, for example, in InsurTech, they want to meet as many exciting InsurTech companies as possible. Doesn't mean you meet their criteria, and chances are particularly if you're in a very early stage, you're too early for them. They will still want to meet. And they all say, look, we should start this an hour, a year, 2 years in advance of the funding round. That's just bullshit. If you are a pretty hot company, you go to them 3 to 6 months before and you'll be absolutely fine.
Great. Well, I think that's great advice. It's as much about what not to do as what to do. And I know you found a few of your contacts for renewal through InsTech London, didn't you? Can you just talk just very briefly about that?
Yeah, I did. So I was, although I have fintech background, and I know a lot of people in that world due to my role as a syndicate room founder. When I sort of fell into insurtech and I started digging and falling in love for insurtech, I saw it in InsTech London and I thought, oh, great, an event. Do you remember those things where people used to meet in London, everyone together having a drink in the evening? Yeah. So back in the day, I went, and that's actually when I met you, Matthew, and a whole bunch. I must have met about 80% of the people that I know in insurtech before lockdown was definitely through those evening events, and then you just build the network from there. It's a small world; everyone knows everybody else. So I started. Hey, look, same strategy as with the business angels. Hey, can you introduce me to someone that can help me? Oh yeah, what about person A or person B? Oh great, that'll be a great introduction. And now with lockdown and everyone working remotely, I personally have been finding it a lot easier to get those sort of half an hour calls that become very helpful. Or if actually they're not suitable for whatever reason, then you didn't really waste a lot of time going into London, coming back, traveling in a tube, and etc. So yes, so thank you very much, Matthew, for the vast majority of people I know in this space.
No, thank you. We'll take that plug and we'll reuse it lots of places elsewhere. But Goncalo, thank you for sharing that. Some really good insights in there. I just want to make sure we've got time to talk to Sam as well. So we'll come back to you later on. But many thanks. So Sam, delighted to have you joining us today. You, I think, founded your first company, main company, age 24, and have been building out insurance since then with the Freedom Group, and then most recently have launched a business, Stella, in insurance in Australia, which I think you're not quite there physically yet, but interested to hear about what the background was for that. I'm just going to unmute your mic as well. There you go. Great. Well, listen, it's great you could join us, and I'd love to hear from you. Back in the early days when you were raising funds, maybe just think about that first of all. How did you start a business off when you're age 24, and then secondly, be interested in your lessons learned for anybody else out there at that stage fundraising. But your own personal story would be great, first of all.
Well, I'm pretty appalling at raising money, so I'm glad I've probably got slightly less time because I learned a lot in the last conversation. I sort of joke about it. The latest project, Stella, is the first time I've ever actually managed to successfully raise money. So you could say I was pretty bad at it. But then, as Andre was saying earlier, I think you can create a really good business by being self-funded. It just depends what sector you're in and whether you are able to generate revenues doing what you're doing fairly quickly. For me, I started from my sister's conservatory, which somebody said the other day is the most middle-class founder's story you could ever possibly imagine. So I might have to change it to the shed or, back garden or something. But I was phoning around insurance brokers. I had a desk and a phone and, 21 years ago, so Yellow Pages. And I was trying to persuade them to give me a chance because I knew if they would give me an opportunity to handle some of their claims, which was the business I was trying to generate, I could start to generate a bit of momentum. And I guess it's similar to your sort of 30-minute call funding conversations. If you stick it out there and you connect with people and you have the right conversations at the right time, really what you're looking for is an opportunity for somebody to give you a chance. And I think, all entrepreneurs will have to go through that stage, whether it be in terms of accessing funding or getting that first client on board. You're really just trying to get that individual to say, okay, well, you might not have the longest track record, or I might not, have used your product before or a version of your product, but I'm prepared to test it and go through that journey with you.
It's a great story. But the challenge of bootstrapping is, I think, to two immediate challenges come to mind. One is how do you charge the right prices? I mean, maybe what you were doing, maybe the prices are more well defined, but I think a problem for a lot of people is not necessarily charging high enough. And then the kind of related question is, how do you then get the funds to grow? Because if you can only grow as fast as your revenue and you've got to pay people, what's your sort of advice to people in that early stage if they are going down the bootstrapping route to be able to generate enough money to grow the business?
Well, I guess for me, it was quite a simple equation. I was trying to make enough money to cover my costs and not have to go back and get a job, which, sounds very rudimentary, but if you kind of break it down, I think breaking it down to manageable units is really important. How do you eat an elephant one bite at a time? If you look at the big problem, you're inevitably going to lose your momentum and your enthusiasm. If you say, okay, well, I need to earn £4,000 a month so that I can hire one other person, because if I hire one other person, they can start to do X. Then your first problem is just getting to the £4,000. And I'm a great believer in, when you're climbing the mountain, I don't think it's always good for you to be looking at the top. And, I did a trek to Mont Blanc with some other insurance people a couple of years ago, and I can assure you, don't look up. It's tough going, you're out of breath, one step in front of another and another to get there. But it is tough. One of the things that I used to kind of make step changes in my business were partners that got an equal benefit from what I was doing. So the claims business worked with a variety of different partners, solicitors, car hire companies, etc. And I realized that what I was producing was very valuable to them, and they had deeper pockets than me, and, would potentially support me in some of these endeavors. So whilst it wasn't raising money from an equity viewpoint, I would go to a business partner and I'd say, I think I can produce you X. However, I haven't got enough funding to be able to do that right now. So how can you potentially support me giving you what you want? And I did a number of deals like that over the years that would just give me a degree of a step change in the business, and then we'd bed that in and then carry on from there.
No, that's really interesting. And then moving on to Stella. So if I've got this correctly, Stella Insurance is for women, run by women. There's probably some more aspect for auto insurance in Australia. And you said just earlier on that you raised money for that. So great just to hear a couple of words about, we'll give you a couple of minutes about Stella and then your fundraising experience at this stage.
Yeah, so I mean, my experience in Australia was a lot more successful than my experience in the UK, because I did over the years try and raise money through various different angles, but hit a lot of brick walls. So I clearly need to take some more tips from this webinar to be able to do it. But Stella, I made a very clear decision early doors. I'd been over to Australia. I really liked it as an opportunity commercially, and I did a couple of projects that were, shall we say, low cost to test. So, just a test and learn project. I did some work with a couple of insurance companies over there from a claims perspective. And then one of the insurers started chatting to me about whether I would look at doing an MGA in Australia. And I made a decision very early on that I wouldn't do it unless I could get investment, because self-funded in the UK, we've got a lot going on in the UK. And I said, this will be a stretch too far for the team and me personally without some additional support. And then I think it's, for me, it was about making the business come alive without it actually being, producing something. So that's about sticking things on the board and the pieces of the puzzle so that somebody else can see what you see. And that for me meant that I needed to get certain contracts in place so that people would have that confidence. So for an MGA, I needed insurance capacity. So I needed to get that deal done before I could go to an investor, because otherwise it's an idea. There's lots of people that want money that have fantastic ideas, but investors, want to know that you've got something with more substance. Now, that doesn't need to be revenues. It can be letters of intent, capacity deals. I did a deal with Bauer Media as a partnership deal, and I did a deal with an insurance company to provide capacity. So I was able to make that picture come alive. And then I put a presentation deck together, and I went to Willis, actually, who are a reinsurance broker in the UK. And for the first time I said, who do you think might be interested in this kind of proposition? And they recommended a insurance investor in Australia. I went out to see him and he ripped my arm off to do the deal. So I didn't actually have to speak to anybody else. It was just kind of done, which was, which was great, which was absolutely fantastic.
No, it was great to hear that, and congratulations on that. And so Australia, I mean, logistically very tough being in the UK. You're actually, ironically, I was on a call this morning with somebody at 7:30. He's based in Australia, and he's doing calls at 2 a.m. in the morning back to the rest of the world. Is it because there was apart from the obvious weather, but this time of year, but is there just a sort of more opportunity out there than there is in the UK? Was that the sort of reason for Australia versus the UK?
I mean, I think there's different kinds of opportunities in Australia than there is in the UK. Every market's got its nuance. It's obviously a smaller motor market, but it's still 4 billion. There's probably less competition. There are some things that we do in the UK that I think add real value in Australia. But there's some stuff about the Australian market that's really quite special and probably better equipped than some of the UK propositions. I don't find, so I've done a few businesses overseas, and I think a lot of it is mindset. We've all learned to work on video calls since the COVID pandemic, which we all would have said, there's no way you can do, the amount of times people would say, you can't do a deal over video, you got to be face to face. I love engaging with other human beings and us all being in a room together. But when that's not available, you can, very efficiently do business. And I'm quite a trusting person. I like to put the right people in roles and then empower them to do the job. So for me, it was about making sure that I could get the right general manager on the ground, give her the tools that she needed to be successful and support as much as I possibly could, but ultimately trust that person to build that unit for you. And, I find now with the video calls, it's a bit of a moot point. Yes, you tend to be, I was on a video call with the Stella shareholders at 6:30 this morning. It's not the end of the world. You're a little bit earlier or you're a little bit later, but you can normally balance these things out.
That's great. And then just finally, before we sort of wrap up, just in terms of female founders, there's been various people that have expressed the challenges of raising funds, but there's been a couple of reports. I think Forbes did one recently about the relative success of female founders versus male founders in companies. Are you finding, over time that are we actually making progress now about sort of diversity in the industry and people being more responsive to female founders coming in? Or I know there are still challenges, but are we heading in the right direction now?
I mean, statistically, unfortunately, not. So every pound of for every £100 of funding, only £1 goes to female-founded businesses, and that's not just because there's less women putting businesses forward. It's that they are generally not as well received, and there's loads of reasons behind that. I don't think that there's a bunch of guys in a room making a decision that they're going to block women out. I think the intent is there. I think the insurance industry as a whole does want to improve its diversity and engage, but you really will struggle with unconscious bias. So, in any funding circle, people will gravitate towards people that look, act and sound like them. And unfortunately, because it's been male dominated for such a long period of time, it will inevitably go that way. And they'll say, when we were chatting before, Andrew will say, it's about the team. But some of that is an emotional connection. Some of those emotions aren't completely objective. I might walk into a room and if there's a gobby northerner in there, I feel an instant kind of draw to them because it's your kinship. You're like, okay, I know this person, I feel safe with them. And I think we do still have that challenge with female entrepreneurs, that there's a lack of faith in them from the male investors. and they don't quite know why, but they'll pass on deals that maybe they would have accepted otherwise.
Yeah, no, sorry to hear it's not moving as fast as it should be. Hopefully we can help change that. But Sam, thank you very much for that. I'm going to pass over to Robin and his team now. So we're all going to disappear from view. I'm going to stay here until Robin turns up. But thank you to everybody else, and we'll hopefully get back at the end for some questions. Okay, Sam, Goncalo, Andre. I'm your commercial break. Oh, there's Robin. Okay, Robin, over to you now. I can disappear.
I'm waiting. Yes, just Jonathan. Hello. Thank you, you four. That was fantastic, Andre, Matthew, Goncalo, Sam. Remind me never to do a startup in Australia, because the idea of doing calls at 6:30 in the morning wouldn't work with me. So my team here, top right-hand corner, Jonathan Spry. Jonathan, welcome. He is the CEO of Envelope Risk. And down at the bottom of my screen, Pranjal, Arya, the commercial director of Hometree. I'm going to call you Pran. Is that better than Pranjal? Good, thank you. Let's start with Hometree, which I think is less well known. And I'm going to try and describe what you do, and then you can critique this afterwards. I say you're a comprehensive boiler, heating and home care plan provider, meaning that you repair and maintain boilers and heaters for your heating for your customers. But you also then are insurers, in the sense that they pay a regular monthly subscription to cap all those costs. And then you might not like this. This might be underselling you a little bit, but do you really just do what British Gas's home care service does, except you just do it a bit better? Is that fair?
Yeah, I think if you were to describe us today, so I think that's quite a good summary. But I think ultimately our aim is to provide peace of mind in the home, to ensure that homeowners or landlords know that if something breaks down or something goes wrong, they don't have to scour the yellow pages or check a trade or find a plumber that may or may not be reputable, but they know that they've got a company there to look after them if something goes wrong, and also obviously to pay for that as well. And that, as I started in the kind of heating, plumbing, drains, electrics, but we want that to be the overall home, moving into security and other things like that as well. And go into more detail.
But then, when if I'm an investor, then I look at your business and I think, well, that's complicated now, because that's not one business, that's two businesses. What you've got there is effectively a logistics business, which is mobilizing lots of engineers who can get to your customers as quickly as possible. And presumably there's a kind of smart app which organizes those. And then probably of more interest to our audience is the insurance piece. Tell us a little bit about how that works and who you work with and so on.
Yeah, so I think you're right. It's a complicated business because it's a marketplace business on one end, like Uber or Airbnb, where you're connecting engineers to homeowners or tradespeople. And then on the other side, there's the insurance piece as well. So to just deep dive on the insurance piece, we are underwritten by a big Swiss insurer called Helvetia. And they are responsible for all the payments for the claims. But we take the customer's money, we give them we give it to Helvetia, and we take a commission out of that. And then we also are regulated to sell those products as well. And we trade on, we're not directly authorized by the FCA. We trade on a license of a company called CBS. And they are in charge of our compliance to ensure that we're not mis-selling and things like that, which have been a problem in our industry. I think one of the big competitors, HomeServe, had a big issue many years ago around that. So quite a complex insurance setup, which we've had to navigate over the last few months, actually.
No, I don't doubt it. And then, so when we're really here to talk about the money, where are you with that? I came across you because I saw you raised a bunch of money a few months ago.
Yeah, so we raised our Series A extension, which was about £7 million back in April time, which, if you remember, was probably the worst time to do any work, but to raise money was a particular challenge. So it was a bit of an ordeal. So we had 3 or 4 term sheets ready to go. We had our existing investors ready to give us more money, and we had a couple of other VCs ready as well. But obviously, when the world went shut down, a lot of them, or in fact, all of them, said, unfortunately, we're going to have to see how this pans out, and took the term sheets away. So we had a couple of months of money left, knowing we needed to get more money in and get a new investor in. And luckily, through a lot of hard work, we managed to bring on Anthemis, which are a leading insurtech investor, to come in with our existing investors to give us the Series A extension, which gives us a good 18-24 months of capital to see out the rest of this year and obviously the rest of next year. And I think one of the main reasons we had that was, as we all moved to work from home, our sales were going through the roof every day. We grew 300% this year, and as homes became more and more important to people, and our competitors who haven't been tech-led had to shut down call centers, and therefore service levels dropped off and actually turned off acquisition of new customers completely. So we managed to really see out of obviously the crisis, a really positive element in terms of getting funding over, but also seeing sales go through the roof.
I find it difficult enough to work out what's seed, what's Series A, and now I've got to deal with another one, a Series A extension. That's it's a new one for me.
Yeah.
So we're great fans of Anthemis in this program. Why them particularly?
Yeah, so I won't go into the details, but this product sits in a grey area where it doesn't have to be sold as an insurance product. So when we first started trading back 2 years ago, we were able to launch without having to go through all of the regulatory hoops that it takes to become an insurer, to become FCA regulated, to get an underwriter, etc. However, we always knew that from a customer point of view, to give them the peace of mind that we have an underwriter, there's the ombudsman that they can go to. We knew that really, and in the long term, to take the risk off our balance sheet, we knew that we wanted to move to becoming fully insured. And in order to do that, we wanted to have an investor that really understood the space, and actually from a funding point of view for our next funding round could help us position ourselves as an insurtech because it's so hot, because there's so much movement in it at the moment. So we saw Anthemis as one of the leading insurtechs. They have a wide understanding of the market. They've helped us navigate some of the regulatory hoops. And Ruth, who sits on our board, has had previous investments such as Lemonade, which we thought would be a great addition to give us some of that insight.
Bit of that magic dust. Yeah, I mean, it sounds like a top tip is find an investor who understands your business. It doesn't look like you struggle to raise money. What attributes have you got that you pushed hard with investors to make yourselves look attractive in their eyes, do you think?
Yeah, I think whilst it is complex, I think they really liked the two parts of the business and a nice intersection between insurance and the marketplace business. So from an insurance point of view, we weren't, as you said, as you started off, we're not creating a new market with new risks and unknown risk profiles. We're trying to disrupt an existing market where we think that the current incumbents haven't done a great job at innovating or improving on the customer journey, but at least the risk profile is very certain. So we know, and we've got years and years of data of the risk profiles of different customers, and we didn't have to try and explain that to our investors. They knew that our margins were going to be relatively predictable because it's been a proven business model for many years. So I think on the insurance side, it was an opportunity to a low risk investment. I think on the marketplace side, even more than the insurance side, there's huge opportunities to completely digitalize the customer experience, not just from the claims point of view, but getting an engineer into other people's homes is a big logistical problem. And it's very offline today. Engineers are notoriously slow to adopt. They're not new adopters or early adopters. So a big part of our kind of thesis was we've been able to digitalize that claims experience, not just from the money paid out, but to actually getting an engineer to the home and getting them to fix it first time. So I think that was a big trend to kind of Uberify or the kind of claims experience. I think there was also two other macro trends that investors really liked. I think in insurance, we've talked about the use of IoT or smart home devices to help, especially in home insurance, to help, or car insurance, to help understand risk better. But it hasn't really worked in the home yet. Leak detectors have not yet really seen any benefits for home insurers. However, if we can understand boilers and the heating system better, and the technology is there today, we can start predictively going out and fixing issues, or actually understanding what's wrong and allowing the customer to fix it remotely. Something like 30 to 40% of issues are just the engineer resetting the boiler or actually just turning it on in the first place. We have that access. We're starting to get access to that data now to really reduce the collective breakdown frequency. And then finally, I think the third element was the decarbonization of the home. So 20 to 30% of all carbon emissions come from the home. And until recently, no one's really talked about that. We've talked about de-electrifying the road network, etc. But a big part of that is clearly from heating. And there isn't really a brand in the market today that can position themselves as helping accelerate that process. You need a whole bunch of new engineers, retrained, as well as new technologies. And British Gas, it's in the name. Gas is their bread and butter. For them to be leading the charge towards decarbonization is going to be a tough one for their brand. And that's where we are. So our platform is completely, our platform, our brand is completely technology agnostic. We connect tradespeople to homes, whether they're gas engineers, electricians, whether they can service heat pumps. So I think the investors really like that, to really help accelerate that.
Thank you. So last question, what would be your top tips? For people following in your footsteps, 2021 with 7 million to raise, what advice could you give them?
Yeah, I think I might go slightly against Goncalo, actually, is that a lot of the luck, I say luck, but a lot of the work that we'd done to get a few investors lined up started 2-3 years ago. Simon, our CEO, is very good at building relationships with investors and bringing them on our journey. So that when over the last 2 or 3 years, he's kept them up to date. We've kind of spoken to them about the changes in the business, etc. And then when it came to actually trying to raise money, they actually fully knew our story. We knew, and we also knew how to pitch the business to them, because we knew what they were looking for. We knew the metrics that they wanted us to explain to them. So I think we were able to actually build relationships for many years, but then actually focus the fundraising into a very short period of time, a 2 to 4 week period around April, May, because a lot of the legwork had been done and it didn't require a few of the key people being out of the business for too long. And I think the other big learning for us was insurance is it's a very competitive industry and is a very specialist industry. And actually we had a good balanced team where we had younger people. CEO and I had never worked in insurance before, but we also had in the management team the ex-CFO, commercial CFO of British Gas Insurance, who knew this industry extremely well. So with a lot of credibility could explain the risk profiles, the margins, the numbers, the metrics to a lot better level of credibility than people who never worked in the industry. So I think for me, it's kind of starting early from a relationship point of view, but focusing the actual fundraising in a short period of time, but also making sure you have the right team and blend when you're fundraising to make sure that you can talk about credibility about this market.
If we have time, we'll come back to you, but thank you very much. Very enlightening. Jonathan, your turn. You're in the spotlight. I think you have one of the most complicated businesses to explain of anyone in InsurTech. So you bear with me, because I'm going to have a go at this, and you give it marks out of 10, right? So I think what you guys do is you're a global specialty cyber and emerging risk insurance analytics and underwriting company. So you take data-driven underwriting expertise and advanced analytics to develop price insurance products for commercial and specialty insurers. your kind of thesis is that specialty world needs to reinvent itself for a sort of more complex, interconnected and competitive world. And you're providing what I call as a kind of insurance underwriting and analytics combined as a service platform. Would that be? Is that am I nearly there?
I'm going to give you 9 out of 10 for that, Robin. I think that's a fairly.
Well, I'll take that. That took me a long time. So we talked earlier to Pran about how his business was affected in 2020. Was it a knockback for you, or did you swan through?
I don't think it was plain sailing. Clearly, the lockdowns that came attendant to COVID put a lot of focus on people working from home. There's some cyber risk inherent in that. And as you know, cyber is our main focus. So actually, it drew a lot of attention to cyber risk and the need to mitigate that. And I think has driven people towards the insurance. And we see that through the reinsurance operation we have. In terms of us functioning, like most insurtechs, I'm sure we've been set up in a way where we feel quite comfortable working in a distributed virtual manner. It probably has slowed down some of the EC3 business development, if you like, which is because the counterparties are used to dealing with people face to face and doing their business in the old way. Clearly, the industry has adapted. So I think overall, we're pretty comfortable with where we got to this year. And there's huge focus, as with anyone, on what now is possible in 2021 with vaccines being dished out from today onwards. So that's great news.
So you that were amongst several who then announced decent fundraising in the middle of lockdown. Tell us about that. What did you raise, and were you doing it beforehand, or did you start it then? How did that work out?
Yeah, we began the process before anyone knew what coronavirus was, but we'd only really briefed people. We certainly weren't in due diligence. So once we saw the writing on the wall, what was happening in Italy, I guess, was a bit of a trigger point. We thought we better get on with this before the world goes into a complete freeze of isolation and lockdown. So we were fortunate we managed to close that, during the first UK lockdown. And that's a credit to the team, but also to the investors that were able to continue to punch on through at that point. So.
Yeah. How much did you raise?
It was about $6 million. I think is what we disclosed.
And who led it?
So led by a VC called Alpha Intelligence Capital, who are completely new to insurance and insurtech world. And there were, of course, some challenges with that, but we'd known them for a while. And they'd invested in a company that we'd worked very closely with previously. And in fact, were part of our corporate founding team. And they'd asked us to attend and to speak at CogX before, which is, as you may know, a very large AI gathering in London, one of the largest in the world. And we really enjoyed that and got to know them a lot better, and managed to kind of persuade them that what we were doing was not just intriguing, but commercially could be feasible too. So that led us to then keep in touch and then get them to the table for this. And we were fortunate in bringing quite a few other investors into that as well. So.
And it's the AI bit that intrigues them rather than the insurance bit, or it's the AI being used in insurance that intrigues them. Is that fair?
That's right. I mean, and your introduction to us at the beginning, Robin, in a way makes me answering the question much harder as to how do we get investors. And I think the answer is that you need a strong narrative, which is pretty straightforward and simple for people to understand. And I think anything that involves reinsurance rather than insurance involves the underwriting process, maybe rather than just distribution, and where you're using a platform type approach. In our case, we're typically operating like an MGA. It's not a SaaS business. So the business model, I don't think, was immediately intuitive to those investors. But once they understood it, they actually really got it pretty quickly, and became very, very excited about the potential to use AI to make better underwriting decisions. And in a nutshell, that's all we're about. We're just reducing the potential for sloppy underwriting, judgment under uncertainty, and so on.
But you, in your sort of career to date, you've been on both sides of the fence. So I think you're the best person amongst the assembled to ask this question to. Have you any observations on the investor world right now and VCs and how they're behaving and whether or not they could do more? I mean, what's your view of that? It's
a very good question, and I think it's a complicated and complex space. It's nuanced. There is a lot of money flowing around in VCs, and InsurTech has definitely caught the imagination of those investors. I'm not always particularly impressed with meeting VCs and discussing insurance and InsurTech opportunities. I think there is a bigger question as to how innovation should be financed in the insurance sector and whether we should be looking towards a series of startups and entrepreneurial finance and VC financing on one hand, or the corporate venture capital innovation labs on the other. We took the view that the truth is that probably somewhere in between, some kind of hybrid model of innovation where you need to be working with the best from the industry, but allowing new money to come in and teams to get started, potentially with a view that the exits are either industry exits or there's some consolidation and a new model emerges. What we found is a lot of VCs, and frankly more in the UK, outside of the UK, the US, I think the sophistication can be a bit higher if I'm, unfortunately, if I'm candid. And clearly there are exceptions. So there are a number of the firms here today have been funded by the likes of Amphimis or local globals, and where they genuinely have insurance expertise, particularly around the distribution side. So not questioning that at all. But we have found that, you know, if you move away from the familiarity of a SaaS type business model, if you're not necessarily as concentrated on disruption and distribution, but actually you're trying to get to the heart of decision making and thinking about things like risk finance and capital, the VC's not necessarily well versed on those topics, and that means, you know, you still get the questions about, well, what's your total addressable market? It's like, I don't know, how big's the insurance industry? 200 billion in reinsurance, maybe 200 billion in specialty. You know, what's your sales cycle, your acquisition cost for customers? And like, well, what's the cost of phoning up a broker? These aren't questions that are really going to get you very high level of understanding into what we do. And then we were very refreshed when we found some investors that actually were more blue ocean in their thinking, and understood that actually the power of what we're doing is an ecosystem play. We're filling some gaps there and enabling, working with people like MS Amlin and others to actually just enable the ecosystem to grow. And I don't think any of us have a clue as to how big that could be. And there's no point sticking that in a spreadsheet and sending it to a VC, right?
So in a couple of minutes, because we're running out of time, what if with people who are following in your footsteps, with businesses like yours, what would be your top tips? How would you any top tips for them?
Yeah, I think look at the investment structure and think about your cap table now, but where you want it to be and how you want it to evolve. And we have a tendency in the UK of letting the tax tail wag the investment dog, and things like EIS, SEIS, VCT funding, that can be very, very helpful and powerful, as is, you know, the future fund and alike. But make sure that you're dealing with the fundamentals of investment. And you know, we've tended to be quite successful at avoiding some of the pitfalls of VCs. We've never given away particularly horrible term sheets. And if there's stuff in term sheets that we don't like, we typically would rather find a way of being self-financing or being, you know, finding another source of capital than giving away lots of anti-dilution provisions and liquidation preferences and all the rest of it. So I think, you know, focus on the term sheet and the cap table, and then just make sure your narrative is clear. And it is obvious that VC investors want to see a good jockey and a good horse. And in our case, we have a bigger team of jockeys with a range of skill sets. I'm an old-fashioned insurance guy, but actually most of our exec have got skill sets that come from the technology and defense industry, artificial intelligence, and so on. So how you get your team and how you show how you've mapped your team to your narrative and to the business that you've identified, I think is really important.
Jonathan, thank you. That's really enlightening. At this point, I'll invite everybody back. You know, in time-honoured fashion, you know, we get everybody back for a sort of a wave and an encore, the chorus coming back to sing again. In the meantime, Jonathan, I've got one question for you. This analysis of you've got to have a good jockey and you've got to have a good horse. In the InsTech London parlance, between Matthew and I, who's the jockey and who's the horse, do you think?
I don't know, but sometimes with these pantomime horses, it's hard to see who's at the front and who's at the rear, right? Maybe I'll answer it that way. It is that time of year.
I think that's a seasonal answer. It works very well. Thank you. Matthew, back to you on that note.
Very tactful, Jonathan. Well, just given where we are at the time, and we've had some fantastic input from everybody. So thank you very much. Thank you to the audience. Just do a very, very quick run through of everybody, just the kind of highlights that I took away from this. So, Andre, you had the really good observation of how to spend the money and make sure people spend it on the right things. Build is often not the right answer. Buy is better. They can come to you if they're talking about past. That was really helpful. Goncalo, I think your point about not every VC has got your interests at heart, so you don't have to kiss all the frogs, but make sure you choose your frogs carefully. Sam, I think you had some great advice there about the sort of partners, and there are ways to find, if not cash, you can get things for free early on that can really help you to scale the business. So lots of great insights in there, but that's the one that took away. Pran, I think you had, for me, what was really interesting is you've got a very distinctive offering there. You distinguish yourself from others in terms of, particularly, I think we're going to see a lot coming in that whole global carbon footprint area, and be able to link that into risk management and stopping the things go wrong in the first place is great. Jonathan, again, a huge amount to take away from that. I think your point about getting the team right and the head and legs of the pantomime horse is gives real value. And also, we had a question on this, we haven't really got time to unpick it, but the balance between the kind of the VC, the smart VC, meaning they know insurance, and then the kind of corporate VC or corporates in there is worthy of a whole discussion on itself. And that landscape is changing all the time. So thank you to everybody. Just a quick advert for our next event, which is coming up on the 15th of December. It's our last one for the year. We're making it a bit lighthearted. We've got predictions from 20 of our friends who are joining us over a glass of wine. Andre, I hope we're going to see you there. We just need to know what color of wine you need to drink. But everybody else, if we don't see before the end of the year, thank you for your support in these crazy times. We were debating before we started how soon we can all get back together and cozy up in the Steelyard. And maybe Rob and I will have to be out there leading the charge and see who will join us. But we very much hope to get everybody back together soon next year once it's all health and safety to do so. But with that, good night and thank you very much.
Thank you.
Thank you.
Right.